Hey guys, I had a few questions come my way about the Silicon Valley Bank collapse, so I thought I'd put together a quick video explaining everything to you guys. First and foremost, so when you go to deposit your money with the bank has to retain a certain percentage of that deposit and keep it on hand when they can turn around and reinvest the larger portion of it. And that's how banks make their money. They're going to take your money and leverage it via an auto loan, a mortgage, buying different securities, right? So they create all this interest off of it. They pay you a small interest rate for the money that you deposited there, and then they just compound their wealth by continuing to do that. Now, what happened with the Silicon Valley Bank is they had a huge influx of deposits. I think they had upwards of $168 billion deposited with them. And when mortgage rates were really low, what they did is they thought they were going to do make a safe investment, and they took a majority of this money and tied it up into long-term in securities, so mortgage-backed securities and government bonds like 10-year treasuries. So when the interest rates started to go back up, a lot of their depositors wanted to then pull their money out because they're only making maybe 0.5% interest on their deposit and put that into a government security that was maybe paying closer to 4 or 5%. So makes sense, right? But if you had a lot of people doing this, pulling their money out to try and reinvest it, and the bank only holds a smaller portion of it, say 10%, then what they have to do is they have to turn around and start selling these assets, selling their assets to liquidate, to get some money so that they can give it to you so you can turn around and reinvest it. Well, what they're having to do is sell a lot of these assets at a loss to be able to do that. So if you think about it, when you invest into a mortgage, you've got that note for 30 years unless you turn around and resell it. Well, they had a lot of mortgage-backed securities when interest rates were low. Now that interest rates are higher, why would another investor turn around and buy the lower interest rate mortgages when they can get a higher interest rate mortgage, right? So they're not getting their money's worth on the mortgage-backed securities. Same with the 10-year treasuries with the government. That money's tied up with them, and everyone's moving their money to these higher interest yielding bonds. So when the investors, big investors in Wall Street, kind of heard the news on this and smelt the blood, then what they did is they started selling the stock on the company. And so the bank then in turn couldn't really sell their stock because the stock was going down. So then to sell their stock, they'd be losing money there. And then that's when there started to become a run on the bank. So a big run on the bank was when everyone went in and was trying to pull their money out and move it, and they just weren't solvent. They didn't have enough money to be able to give it to their customers. In a nutshell, when the bank went and took all that money and they invested it into these long-term securities, that's where they messed up. They had a way too high percentage of their money tied up into long-term investments instead of having short-term investments where they could liquidate those securities if needed. Hope that helps explain everything. I tried to really kind of cram it in there for you to keep this video short, but give me a call if you have any questions. Hope you're having a great day.